So in today's lecture, we already talked about the definitions of unemployment and the types of unemployment, and then we also talk about the cost and benefit of unemployment. Toward the end of today's lecture, we want to see if there is any model describing the existence of unemployment. So to begin with, we want to review the classical view and the Keynesian view about unemployment. Under the classical view, we say that the supply and demand of labor market always rapidly adjust without a cause, such that it will be able to restore the equilibrium quickly. When we say restore the equilibrium, we mean that the supply equals the demand. So then the classical model probably is not that easy to describe the existence of unemployment, because given that the price adjusts rapidly such that the total labor supply equal to the total labor demanded, then there shouldn't be any unemployment. Therefore, when we want to talk about a model that describing the unemployment, the simplest way is that we look at the Keynesian view about unemployment. In here, we want to talk about the new Keynesian view about unemployment. Here we say that the firm explicitly recognize their pool of workers as a stock, and this worker can associate with a slow and fast turnover. When the turnover is fast, then the firm needs to cost to find new people to fill in the vacancies. If the turnover is low, then it's less costly, but then it's costly to maintain the stock of workers because you need to pay higher wages to keep the turnover rates low. Therefore, the firm desires to minimize the searching costs by adjusting the real wages they paid. And this will be the underlying assumptions that we have in mind when we look at the new Keynesian model of unemployment. So to describe the unemployment quantitatively under the new Keynesian view, we made a couple assumptions. The first assumption we made is that the labor supply is the function of wages, and we assume it to be just simply the labor supply equal to the wage rate. In this equation, it tells us when the wage rate is higher, the quantity of labor supply should be higher. The second assumption we made is related to the labor demand, and we assume that the firm make the decision about how many labor they want to demand based on the result of the profit maximization problem. Therefore, the firm solving the problem of profit maximization by choosing the L. And for this problem, we are given a production function that the Y is equal the labor demand minus a half of the square of the labor demand. And from this equation, we will be able to derive the labor demand function by solving the profit maximization problem. So the third assumption we made is that it's costly to search for new workers, and the searching cost is associated with wages. So then we assume that the searching cost is a function of real wages. We assume it to be 1 minus 2 times of the real wages plus the square of real wages when the real wages is less than 1. And this function equals 0 when the real wages is greater than 1. Because of that, when we focus on the part that the real wages is less than 1, we can rearrange the equation. We are going to have this equation equals 1 minus the real wages, the whole term squares. And then we will be able to draw this function. And we know that if we are focusing on the part that the cost is positive, then we are focusing on the left-hand side of this curve. That is, when the wage rate is higher, then the cost for searching will be lower. So under these assumptions, we know that when the real wages is higher, we are going to reduce the searching cost. However, when we reduce the searching cost, it implies that the wage cost should be higher. Therefore, there is a trade-off of different type of costs when we increase the wage rate. Therefore, in here, when we want to determine what is the optimal level of the wage rate that the firms are willing to pay, we are trading off the marginal benefit versus the marginal cost for increasing 1 unit of the real wages. So then what could be the benefit when we increase the wages? It turned out to be we are going to reduce the searching cost. Therefore, what we do is that we take the DC over the real wages, and this cost change will be the benefit for increasing the wages. Because this benefit is about reducing the cost, therefore we need to set up a minus sign before the derivative. So then, based on the equation we set up, the DC over the real wages taking a negative sign will be in this result, that is minus 2 plus 2 times of the real wages. So then what will be the marginal cost for increasing the real wages? It will be the wage rate that you pay. And when you increase the wage rate by 1, then of course you need to pay 1 more unit of wages. So then the marginal cost for increasing the wage rate equals 1. Therefore, we know that when we are solving the optimal level of the wage rate that the firms are willing to pay, we need to set the marginal benefit equal to the marginal cost. Therefore, what we do is that we just set what we get from the marginal benefit, which is 2 minus 2 times of the real wages, equal the marginal cost, which is equaling 1. And then we solve for this equation, and then we are going to be able to determine the optimal level of the wage rate that the firms is willing to pay. It turned out to be a half. And for this wage rate, we call it the efficiency wage. That is the wage rate that will be able to allow us to lower the turnover rate. Therefore, we are going to be able to reduce the searching cost. On the other hand, that for this economy, for sure, there will exist a market clearing wage. To come up with the market clearing wage, we also need to look at the labor supply and the labor demand function, because we know when the economy has its labor market clears, it needs to be that the labor supply equal to the labor demand. So what we have in here is that the labor supply function is this, and then the labor demand function is solved based on the profit maximization problem. Based on the assumption we have for this model, the profit of the firm is the total output minus the total wage payment minus the searching cost for labor. So then this is our profit function, which is Y minus the wage rate multiplied by L minus the searching cost multiplied by L. So then based on this problem, we can solve for the labor demand function. We have the d pi over dl and we set it equals 0. And then given that the output function is L minus a half of the L squared, then when we have the dy over dl, we are going to have 1 minus L. So then once we plug it into the result of the profit maximization problem by choosing the L, we are going to get that the labor demand function can be derived based on this equation, that is 1 minus L minus the real wages minus the searching cost equals 0. And then we are going to get the labor demand function is 1 minus the real wages minus the searching cost. So to come up with the market clearing wage, we need to set the labor supply equal to the labor demand. So we just put the labor supply function and the labor demand function together by equating the L. And then so what we are going to get is that the real wages will equal to 1 minus the real wages minus the searching cost. And the searching cost is 1 minus 2 times of the real wages plus the square of the real wages. And then we are going to get the right-hand side of the equation as the real wages plus the square of the real wages. So then when we rearrange the equation, what we are going to get is that the market clearing wage turned out to be 0. You may find that this result may be weird, but given that at the end the firm is not going to choose the market clearing wages as their wage payment, so then it doesn't matter that this market clearing wage equals 0. But anyway, what we know is that we have the efficiency wage equal a half, but then the market clearing wage equals 0. So then how does this result imply about the unemployment? It turned out that when the efficiency wage equals a half, then the labor supply need to be equal a half. And then when we plug this efficiency wage a half into our labor demand function, we know for this economy the total quantity of labor demanded will equal a quarter. So then we know in here the quantity of labor supply will be greater than the labor demanded, which is implying that there will be unemployment. And what should be the size of unemployment? It will simply be the size of the labor supply minus the size of the quantity of labor demanded, and then we find out the total size of unemployment equals a quarter. So then to come up with the unemployment rate, we are going to have the total size of unemployment divided by the total size of the labor supply, and then we are going to have the unemployment rate equal 50%. And that is the unemployment rate for this economy, which is that the firm's behavior follows the assumption of the efficiency wage theory, that they find out that it's more efficient to pay the wage rate higher than the market clearing wage. And then it turned out that it will causes an unemployment rate which is equal 50%. And for this particular unemployment rate, it is the natural rate of unemployment of this economy. And this natural rate of unemployment is basically caused by wage rigidity, and which is related to the structural unemployment. So to conclude, for this model of unemployment, we solve for the efficiency wage, and then we solve for the market clearing wage, and then we will be able to come up with the natural rate of unemployment of the economy, and it justifies why there always exists unemployment. And this completes the discussion for today's lecture.